And we're back for the 10th edition of the Kansas City Commercial Real Estate Markets Pulse, sponsored by Exchange Commercial Real Estate. And I'm excited. I mean, that means we've been doing these for 5 months now. So almost a full or a half of a year, which is awesome. And it takes a lot of work to stay on top of your market, know your numbers, and be able to interview folks like Blaze and Akil and other groups that we have coming on here. It takes a lot of work to do that. So first off, just shout out to the team here, Katie, Micah, Nathan, spending time doing the research and then coming on and talking about all of the developments and the trends that we are seeing. So kudos. This is a milestone, episode 10, and hopefully we'll be doing this. We're looking at this and it's episode 100, but it's a small milestone here for the Kansas City Commercial Real Estate Market Pulse. And our goal and our aim has always been to deliver valuable, up-to-date information on the commercial real estate market in Kansas City, including any current listings that we are working on, talking about the different market trends that we're seeing and going over notable transactions. And then we're going to have expert insights come on. And we've got a slate of more guests to come on here in the near future. But today I'm excited because it's really one of our broker roundtables. Before we do that, let's talk through our team here. And many of these folks have been able to come to a brokers roundtable and or a previous session. But if this is your first time listening in, first off, thank you for being here. We appreciate your time. And I'm excited to introduce you to our firm, Exchange Commercial Real Estate, and the incredible team that we've got. And our mission is to provide our clients with exceptional expertise, market insights, and results-driven strategies in commercial real estate. We specialize across a variety of asset classes, so from multifamily to retail to industrial and land and beyond. So we're proud to have built a good reputation as a trusted resource here in the Kansas City market. And today we have two of our top experts. First, Micah Beebe is one of our multifamily brokers. He's bringing extensive knowledge and proven success in the multifamily side of the industry. Micah's got a great pulse on the local market and is going to today offer a lot of valuable insights into investment trends, occupancy rates, and rent growth. Next, we've got Nathan Roberts, our retail, industrial, and office broker, who's instrumental in helping clients navigate the unique dynamics of the retail, industrial, and office markets, which we're going to dive into deep today. So Nathan's experience and understanding of market shifts allow him to advise his clients on maximizing value, finding their new location, whether that be buying, selling, or leasing. So together, our team is dedicated to delivering top-notch service and results. And I'm gonna just say it here again. We've been performing these property performance audits for clients, and we've got space for 3 more of these, and they take a lot of time. So that's really only right that we've got space for 3 before the end of the year, because we are delivering much more than just your typical broker opinion of value. We're helping folks with multiple exit scenarios and strategies, return on equity analysis, and we're diving deep with them. So if you own real estate in Kansas City and you're interested in looking at benchmarking your property against a good competitive set, and understanding what your return on equity is, what your options are in regards to holding that property, refinancing that property, or selling that property, definitely reach out to our team. We can help you with that. Without further ado, we are going to get into today's topic, which is our Brokers Roundtable discussion. And I'm excited to do this because it's always fun for me to sit here and not have to do all of the talking or the, really the preparation. I put it all on Micah and all on Nathan today. So Micah, how are you doing today, man?
I'm doing great. It's good to be back on the show with you. I mean, it's been a minute since I've been on here, so it's great to be back. And there's a lot going on in the multifamily space and in the economy, and there's just a lot of different things to talk about. So I'm excited to dive in and talk about what's going on.
We'll do that just here in 1 second. Nathan, how about yourself, man? How are you?
Yeah, I'm doing pretty great. I mean, I don't focus too much on multifamily, so I'm excited to learn from experts like you and Micah on just how the multifamily market is going. But things are great in general commercial real estate. So I'm excited to talk about some of the trends that I'm seeing currently in our market.
Awesome. Micah, let's start with you, man. Can you give us a quick overview of how the multifamily market has performed so far in 2024? And, are there any big shifts from last year that have impacted the way that we're approaching deals and clients are approaching deals?
Yeah, there's been a lot of changes this year. I mean, when we started 2024, if you go back and look at the sales data, I mean, so far year to date, we've got about 70 sales, and that's over 10 units. That's usually a good metric to go by. 10 plus units. We're not talking about uh, senior housing or student housing or anything like that. So this is across the Kansas City metro. And to kind of put that in perspective a little bit, just looking at sales for the last 2 years. So in 2023, we saw about 81 deals transact.
Okay.
And then in 2022, we saw 130 transact. Now, 2024 saw a kind of a slow start to the year because we started in the first quarter, there were only 7 deals that transacted. Um, and when you look back at Q1 of 23, we had 17. And then Q1 of 22, we had 35. So you're talking about a significant difference between Q1 over the last couple of years. Of course, in Q1 of 2022, we hadn't really hit that slump in the market yet. We had not seen all of the interest rate hikes. And now we're kind of getting onto the other side of that, or just the beginning of it, because as everyone knows, we've seen some rate cuts over the last couple of months. We just saw the most recent rate cut, so that's the second one that we've seen this year, and keep them coming. Just keep them coming.
Yeah, absolutely. Well, that's some interesting data right there. I mean, 2022 around 130, 2023 around 80. I imagine we probably land somewhere between 80 to 90 this year on the sales side, because things have been picking up this last quarter. So, based off of that, in the number of properties that have sold in 23 and 22 and where we're sitting in 2024, I mean, what trends are you seeing in terms of, buyer demand or investor interest? I mean, are there certain property types, vintage, class, or locations performing better than others?
Yeah. There's a lot to unpack with that question. I'll tell you that right out of the gate, because I think where we're going to see the market is, we're seeing more activity, more properties are hitting the market. I mean, right now in the KC Metro, you're seeing there are 33 deals listed on the market. And out of that, you have 22 that are still active, and 11 of those are under contract.
Okay.
And so with us having 70 sales year to date, you're exactly right. I think we're going to see in that 80 to 90 properties transact, kind of similar. We're kind of catching up to what last year was. And, but just kind of a reminder for everyone too, is that every market is unique, and Kansas City is certainly no different. I mean, we saw recent reports of rent growth and what we're seeing from across the country. And it was kind of a shocker to see the report where Kansas City was number 2 at 4.1% in rent growth compared to New York City, which was number 1. And so that was pretty wild to see that. And so I think there's a lot of excitement around Kansas City and what's happening here. I mean, just in Kansas City proper, we've got over $2.5 billion worth of developments that are coming online in the next 6 months. And I think I saw a report the other day that said that Lee Summit, a suburb of the Kansas City market, has about 1.7 billion in development in the pipeline. And so we're seeing a tremendous amount of development. There's a lot of dollars coming in. There's a lot of big projects that are coming in. And so people are getting excited. about Kansas City. The way I talk to investors literally from coast to coast that say we want to be in Kansas City. And that is the one place that they want to be across the state of Missouri and Kansas, is that they want to be in the KC market. So there's a lot of excitement around that. Now, with that being said, there's a lot of investors that have been looking at the economy, and there's been a lot of expenses. We've seen record inflation going on. And so there's a lot of turbulence in the market, and especially with rates shooting up as much as they did so quickly, there's certainly some problems there in the market, but so a lot of buyers have been looking for deals. I mean, that makes sense. You're like, okay, where's the distressed properties at?
Sure.
And I got this question just last week, from an out-of-state investor, and they're like, where are the distressed properties at? Like, line me up for that. Give me a good deal. This is a great time to buy. Well, unfortunately, we haven't really seen a whole lot of distress, particularly in the Kansas City market. And so just because we have so many of those indicators that I was mentioning a minute ago, and right here you can see on the slide, I mean, this is $145,000 a unit is the average sales price per unit across the metro area. And so, I mean, when I saw that number, I was a little surprised. I was like, wow, that number is really ticked up, So I think people or investors are really hungry for the KC market. Oh, you just muted yourself, Logan.
Can you guys hear me now?
Yeah, we can hear you.
What I will tell you is you brought the data of 10 plus units, which is what, you're really focused on 50 plus units. But if we actually parsed out that data, the average listings on just LoopNet, we did this a couple of weeks ago. We looked at, what was listed on LoopNet. It was average size was about 22 units, and the vintage was 1920. So smaller properties being older properties, the average price per door on those deals were right around $91,000. So the larger project, probably newer vintage, maybe a nicer location. Obviously, they're going to have a little bit higher price per door. So good data, good insights here. All right, last question for you, Micah, is, just in regards to the competitive landscape that we're seeing right now, how are you advising potential buyers and sellers on positioning themselves effectively in the multifamily market for the rest of 2024 and going into 2025?
Yeah, I mean, my advice to investors, especially that are wanting to get into the Kansas City market, I mean, there's a lot of competition in the investor pool that really want to invest in the Kansas City market, and there's a lot of reasons for that. Again, we've got billions of dollars in investments. We're a host city for the World Cup coming up in 2 years. We hosted the NFL draft, and that was a big one. We've got a brand new airport, which is phenomenal, by the way. If you haven't seen our new airport, we're getting a lot of press on that. It's a huge improvement, but no, I think that when you look at deals in the Kansas City market in particular, I think you need to just look at the metrics of what we're doing here. But I think it's important too that obviously you need to be a cautious investor. You need to really know your numbers. And when you dig into a deal, you need to have that comfort level. I mean, I tell investors this all the time. I said, look, this is the underwriting that we have. These are the projections that we can show you. Obviously, you need to do your own due diligence, of course. But you've got to be really comfortable with where you're going to come in at. But also, and really understand the metrics of what's going on in the market. And so, and of course, you drill down into different sub-markets within Kansas City as well. And there's all sorts of nuances and things that you need to understand about those in particular too. And so that's why it's so important to reach out to experts that we have in our office that can properly advise you on these different locations and the properties and what's happening in the market. And Logan, to your point too, just another thing that we're seeing as well is I'm really hearing from investors across the board is that they want properties that are 1980s vintage and newer. And of course that has to do with, insurance costs, which insurance costs have really spiked. That's a huge expense that investors and property owners are facing. So it's important to have really good contacts so you can shop those rates as well. Also something that we can assist with. But also, I mean, when you have a newer property, it's less upkeep, less to maintain. And so, but anyways, that's kind of where we're at. Kind of a bird's eye view of the market here.
Yeah. So I said it was my last question. I do have one more because Blackstone's acquisition of AIR or AIR communities obviously shows strong institutional confidence in multifamily. So how do you think that these major acquisitions are influencing smaller investors' strategies and the sentiment in the multifamily sector? Because I know a lot of people like to see Blackstone, KKR, some of those larger groups making these big investments. Are you seeing a trickle down effect in regards to the sentiment from the smaller investors?
Yeah, great question. Of course, when you have a large player like Blackstone really re-engage in the market like what they're doing, I think that really communicates to a lot of investors a sense of confidence in the market. And so I think that that is certainly something to pay attention to because, well, and that's something that I've been reading, that a lot of these institutional dollars that have been sitting on the sidelines.
Ooh, we might have lost Micah. Nathan, you still hear me?
And what's going to happen? Oh, there we go. I'm back.
You're back. All right.
You can't get rid of me that easily. I mean,
he's back.
So I mean, I think it's important to watch what these larger institutional investors are doing and how they've been on the sidelines quite a bit and waiting to see what's going on and where things are going, and to see a lot of those guys engage back in the market, really deploy capital, and especially, I mean, seeing what Blackstone did here in this instance, I mean, throwing out $10 billion. I mean, that's a pretty big sign right there saying, hey, we're open for business. I think we're going to start plugging away here.
Yeah, absolutely. Micah, thank you so much for all the insights. We're going to get back to you, but we are going to transition over to Nathan. Nathan, man, how would you summarize, and I know you handle retail, industrial, and office, right? But like, how would you summarize the state of each one of those markets this year? What's different about 2024 compared to previous years in those sectors?
Yeah, I mean, I would say the biggest thing is just growth. There's not really much inventory that's currently being built outside of industrial at this point. So a lot of what I do on the industrial side is majority of it is flex. There's like no flex that's currently being created. So what you have is just a huge gap in what the supply is and what the demand is for those property types.
Sure.
Same with retail. I mean, retail is it's one of those situations where there's just significantly more demand. I mean, across the board, across the U.S. And here in our particular market, I mean, we're in a situation where rents just keep going up because, I mean, spaces that come on the market for retail, I mean, majority of those are being backfilled within 3 to 5 months at the very max. I mean, typically you're getting some sort of letter of intent to lease within 90 days. And I think that was really unheard of probably a couple years back.
Yeah, no, absolutely. What types of properties and or submarkets in those sectors, retail, industrial, and office, have been seeing the most activity?
Yeah, I mean, there's a few submarkets. I would say, I mean, you're looking at areas like Lee Summit, even going down south where there's a little bit more inventory, but the demand is still there's still that demand gap. It's really going to be like that Belton and Raymore area. I mean, there's a lot of inventory down there, but there's just not enough space for the companies that are actually either growing or new companies that are getting started.
Yeah.
Where I'm seeing a lot of the inventory being built, I mean, it's those really large scale tilt up construction type of projects. Really, that's going to be in DeSoto, Kansas, South Johnson County, in the Northland. But those are 1 million square feet plus type of developments. And typically they have some sort of tenant that's going to be going in place for some of that square footage, and getting those leased out isn't going to be super difficult.
Okay. So, we're seeing major institutional acquisitions on the multifamily side. Are you noticing any similar trends in retail and industrial, and how's that affecting the broader market?
Yeah, of course. I mean, when it comes to large syndication groups and things like that, I mean, really they're buying those larger, higher quality or high class properties. I mean, when you're looking at industrial, for example, I mean, really it is those tilt up construction. So once a developer comes in, I mean, they're looking at who is the end buyer for this. It's not going to be owner users. These are investment groups that are coming in to acquire those assets.
Yep.
I would say there's just a lot of demand for it, and there's just not enough inventory that's being built. I mean, out of the three property types that I'm taking a look at, industrial, office, and retail, there's more inventory being built for industrial than any of those other property types.
Yeah, that's great insights, man. Well, let's get into some of the numbers real quick. So talk to us a little bit about what you're observing in the retail, industrial, and office sector in regards to the numbers. So let's start with industrial here.
Yeah, so it's a lot of positive signs. As you can see, the sell price per square foot is going up. I mean, average right now, you're about $65 a square foot for general industrial. When you start looking at flex, I mean, you are going to be at a higher price per square foot, generally in that $80 to about $120 a square foot range. Cap rates are definitely starting to go up, or they have went up compared to last quarter. I think cap rates you're going to start seeing some compression, especially as the market starts to account for some of those the interest rates starts to come down. Market rent, obviously, that's going up across the board. Like I said, I mean, demand is still outpacing what the supply is in the market. We got into a situation last year where there was just so much inventory coming in. We had negative net absorption. Right now, it's positive. So all that is the difference between what came available for lease within a 12-month period and what actually got leased up. So right now, we're at 2.7 million square feet of net absorption. And if we were to compare that number to just this time last year, we were negative a couple million. So this is a good thing. I think supply is starting to come down a little bit more. Obviously, as we start to infill some of that space that comes available, or as things hit the market, they're being leased up. So seeing positive net absorption for industrial real estate, just knowing the supply that has came the past few years, that's actually a great sign.
Yeah, one big trend that I'm going to continue to track and evaluate with you very closely is the onshoring of more and more companies stateside here to control supply chains and logistics. One thing that did jump out to me here was that market cap rate at 9.4%. I think we would need to really dive into what cap rates are, what that's being actually occupied on, calculated off of, because that seems a little bit high, doesn't it?
Yeah. It does seem a little bit high. I mean, when you're comparing it to cap rates on the multifamily or retail side, I mean, this is about 200 basis points higher than those other property types. But I think investors, I mean, really what the sentiment out there is, I mean, typically you want some sort of spread between what your interest rate is and trying to make some sort of returns. Typically, you want to be about 200 to about 300 basis points above what the interest rates are to make the project pencil out. Now, I mean, with that said, with this cap rate, it is a little bit surprising just knowing that a majority of the inventory on the market that's being sold, it's typically in that B class. I mean, a lot of the inventory out there that is A class, I mean, a lot of those are typically long-term buy and hold. So you're not really seeing that inventory that's being sold right now.
Yeah, the other thing I would say is, you're on industrial with the types of the lease structures that you have, there's there's typically a whole lot less value add to actually create. It's if there's a vacancy, your value add is to go lease it up, but they probably have a weighted average lease term somewhere between 3 and 5 on most of these industrial projects. And so it's different than a multifamily deal where you're going to go in and you have shorter lease terms and you can actually start adding value. So you do have to have a higher cap rate for those deals to pencil out. That makes sense.
No, exactly. I mean, when it comes to industrial, for example, I mean, like you said, I mean, if the vacancy is super low I mean, typically these are going to be on a triple net basis. So it's not really super operating intensive on the capital standpoint when it comes to operating those type of properties. I mean, operating expenses, though, that is a pass-through charge to the tenants. Yeah. So that's not anything you have to worry about.
All right, shifting focusing over to the retail side. What trends are you observing here on the retail side here in Kansas City?
Yeah, so for me, I definitely see some correlation between retail and industrial. Obviously, with when it comes to the market price per square foot, that is also up compared to last quarter. It's about $170 a square foot. Market cap rate, that has also went up. That's about 7.5, so about 200 basis points lower than what we just saw on the industrial side.
Wow.
Market rents, I mean, right now we are at an all-time high, $18.30. It's actually pretty crazy, but when you realize when spaces come available and they're being leased up so fast, I mean, the reality is typically in a commercial leasing situation, you're not competing with other tenants, but with retail, you're going to have multiple LOIs typically within 90 days. And I think that's one of the things that's helping drive up that price.
Most definitely, man. If I'm an investor and I'm listening into this, checking out this retail slide here where the cap rates are, where the vacancy rates are, and where the asking rents are, and looking at the construction and absorption, man, there's a lot of tailwinds behind retail right now.
Yeah. So, I mean, we're at all-time highs for the market rent per square foot, and we're at an all-time low for the vacancy rate. So 3.7. Typically, I would say for vacancy rate, you're really going to be in that 4.5 to about 6% range.
Yeah.
Just historically looking at a 5 to 10-year average. And to be at 3.7%, I mean, it definitely makes sense just knowing that there's not really much that's under construction right now. We're under 400,000 square feet of construction compared to looking at industrial where you're over 12 million that's currently being built. Now, with that said, there is a caveat that those are typically for large scale projects.
Mm-hmm. Yeah, I mean, doing urban infill on retail is basically extinct. I mean, there's just not the land to do it. So
if you do find the land, it's very expensive on a per square foot or acreage if you're trying to buy land for development. I mean, majority of what's being developed, I mean, it's not even in the urban core, like you said, with infill space. It's really going to be in the suburbs like Johnson County, looking outside of Overland Park. I mean, that's where you can find ample land and actually make the project pencil with what the land prices will be compared to infill space.
Great insights, man. Great insights. Okay, so I know that office is on a lot of people's minds. Everybody loves to talk about the office space. And, Blackstone has been starting to make their move back into office as well here recently. So tell us a little bit about what's going on in Kansas City office and what trends are we finding here?
Yeah, so I mean, these are pretty much, what you would anticipate. I mean, market rent has, or the market sale price has went down on a per square foot basis. I mean, you're hearing talks about, just looking, if you talk to any professional around the country, majority of them are saying that if you are representing a buyer to buy office, you want to get it, you want to have a very low basis with that property. So it's not surprising that the per square foot price has came down. I mean, comparing it to last year you were around $130 a square foot. I mean, I'm honestly surprised it's not less than $100 per square foot because the properties that I've been seeing trade, I mean, they're selling for less than $100 a square foot. Yeah. I think the things that are actually selling tends to be those higher class offices, or it's going to be owner user type of sales. So if you're looking at owner user compared to investment sales, owner users are typically going to pay a higher price per square foot because they're not typically worried about the numbers. On the market rate side, obviously the cap rate has went up. I mean,
double-digit cap rates.
Yeah, the cap rate's over 10%. And I think primary reason why is because as a lot of investors try to weigh going back into office, they're looking at things from a risk perspective. So with there being increased risk in trying to really see where some companies are trying to take their work from home or having some sort of hybrid model, there is risk to be associated with that. So if you think that a company is going to be pretty much vacating a space, you got to look at what is the timeline and what is the cost to get that space backfilled. I mean, right now, you're looking at least 6 to 9 months for a lot of office spaces to be backfilled, unless it is A-class property. If you're looking at B or C class, there's just a long time horizon to get those backfilled. When it comes to the vacancy rate, obviously that has went up as well. Right now, you're at 11.9%. I would say historically, you're going to be around the 7. So, it has crept up a lot just within the past 2 years. Net absorption, I'm actually surprised that this is a positive number. So this is saying about 500,000 square feet has been leased in what has came available in a 12-month period. But I would also say that there is a caveat that obviously if a space did not come available within 12 months, meaning that it's been on the market for 15 months, it's also not being accounted for in the net absorption. So the reality is there's not much sublet space out there. Most of it is direct at this point because with the sublet space, a lot of that has been filled up pretty quickly, primarily because if you're offering a 25% discount or something along those lines for a space, let's just say it's $25 a square foot and you're able to get it for around 18 and it's higher class property, or let's just say B class property, you're probably going to bite on that and pretty much absorb that lease because you're saving money in the long run. But net absorption, like I said, I'm actually surprised that this is a positive number, just knowing you look at the amount of space that's currently out there. There's a lot.
Absolutely, man. Great insights here.
But one thing I want to say about the market rent per square foot.
That's what I was going to ask you about.
It's at $22.75 a square foot now. I think primarily because there's not much inventory that's being created right now. You're at less than 700 square feet. But then you also have to look at majority of the space that's being leased right now is A-class property. And A-class property is in such high demand right now. That's really what's driving the rents going up. And with demand, I would say demand is relatively the same or it's less, but there's not much inventory coming on the market. So I think we're still going to see in the coming years, I think that market rate is going to go up. As far as rent, like if you're offering concessions or trying to sign a lease, that's not really a negotiating point. They're not going to lower that rent because it affects the valuation of their property. What they are willing to do is offer you concessions such as a free rent period or a tenant improvement allowance. But as far as bringing down that rent, most landlords aren't willing to negotiate on that basis.
Awesome. Thank you so much, Nathan. It's very, very apparent that you have been spending a lot of time understanding the market and bringing a lot of value. So let's shift over, guys, bringing Micah back on here, talking about Kansas City's hottest commercial real estate projects and deals that are happening right now. Before we jump into that, though, I want to talk about population growth because when I was interviewing Blaze from CoStar about the national trends on population growth, it was very apparent to me that Kansas City has been doing a really great job on that. So I want to talk a little bit about why. I think Kansas City is rapidly emerging as a top destination for investment. And we've talked a lot about why that is on previous shows. And Micah, you mentioned that previously as well. I think it's driven by a unique combination of obviously the steady population growth, our economic resilience, and these dynamic new projects that we're going to discuss about. But
there's one other reason, Logan.
Yeah, go ahead.
It's because the Chiefs are 9-0. That's why.
Yeah, even the Royals made a nice playoff run there too. That was a lot. Yeah,
one question I have is there research out there to show like the Taylor Swift effect? Obviously, people are saying that she has heavily impacted the economy, especially with her Eras tour, and obviously with her dating Travis Kelce. I want to see like what impact, what on a GDP basis has she made for the Kansas City region?
Yeah, the only thing that I saw was actually comparing that to the ticket sales on the Dodgers games, and
Okay.
I can't remember what the findings were, but I'm pretty sure the Dodgers games tickets were a lot more than just the tour was. But in regards to Kansas City specifically, I know that there was some preliminary research done by Green Street that we have shared across. So I'll have to go dig that up and find it out. But I don't know if it's changed since then. That was probably 4 or 5 months ago.
Okay.
Yeah. But look, guys, I mean, our metro area has grown by 10% in the last decade. 10%. We're adding between 20 and 25,000 new residents each year, and that's outpacing the national average. And so this growth fuels demand for housing, for retail, for office space, for industrial space, and that's creating opportunities for developers and investors alike. I mean, in addition to the growing population, we've seen job growth of 2.3% over the past year. That's driven by a diversified economy that includes logistics, healthcare, and technology, right? And our GDP continues to climb as well, with a steady annual increase of 1.9%, which is just reinforcing Kansas City's economic stability and resilience. And I mean, yes, these are a lot of statistics, but these numbers just aren't stats. I mean, they translate to tangible development. Over the next 6 months, Micah, you mentioned this, Kansas City is set to break ground on $2.5 billion worth of projects, including major mixed-use developments like the $800 million Kansas City current riverfront neighborhood and the $500 million West Bottoms revitalization by Samara Road. I mean, with these projects, we're not just building new spaces, it's shaping a vibrant, connected future for the city. And so I think about this as well, whether it's the strategic advantage of reaching 80% of the United States within a 2-day drive or our status as a major rail hub. And Kansas City's positioned as a logistics powerhouse. It's a city where growth is matched by opportunity, making now the perfect time to be a part of this incredible transformation. And we're just excited to be a part of it and continue to help clients navigate all of this opportunity. So let's dive in real quick to a couple of these projects, guys. We've got some good questions for you here. Adams Dairy Landing. I mean, this serves as just a massive case study, in my opinion, in the retail center development and market dynamics in Kansas City. I mean, it's got strong anchor tenants and it's got high foot traffic, and it's a successful suburban retail that has continued to adapt to the changing consumer landscape. But I mean, Fidelis Realty Partners, this is their second large acquisition here in the Kansas City area. This is 280,000 square feet in Blue Springs, and they bought it for $39.8 million. Anybody can do that math for me real quick? $39.8 million divided by 280,000 square foot. And Micah, this isn't too far down from you, man. Have you been to this shopping center?
Yeah, I have been to the shopping center. It's a phenomenal shopping center. I mean, it has a lot of really great retailers, and so yeah, I mean, it's a little bit outside of my direct bubble because I'm in the Lee Summit area, and so. But I mean, I've been to this shopping center. I mean, I've driven by it many, many times, and it's a wonderful shopping center. I mean, I think it's Fidelis made a great acquisition here, and so Blue Springs is a great market, and a lot of great things are happening there.
Yeah, I mean, it's 36-acre site, and that's about $142 a square foot. Go ahead, Nathan.
Yeah, I was going to say this feeds into that Eastern Jackson County triangle. Yeah. I mean, people that live and work in Blue Springs or Lee Summit, or vice versa, they live in Independence, they're going down to Lee Summit to do business. They're going over further east on I-70 to go to Blue Springs to do business. So I think this just feeds into the wide variety of different shopping centers that are in that area.
Yeah, Nathan, how does a retail center like Adams Dairy Landing, how does that influence surrounding industrial and retail property values? I mean, are you seeing similar suburban retail models succeed in other places? This is a big purchase, obviously. So and there's probably a lot of retail around that. I can see it in the picture here. But what influence do you think this might have on the surrounding areas?
I mean, it's going to be a positive influence. I mean, typically there is a correlation between the amount of residents that are moving to an area. Blue Springs is growing. their population. So as you see the population tends to grow, that's when shopping centers tend to be older, outdated shopping centers tend to be redeveloped. And really, they're just trying to bring a different type of restaurants or retailers to the area. I mean, right now, I did some research a few weeks back. I mean, what is trending when it comes to restaurant space in general is really going to be the local and healthy food options. There's just not, there's a lot of them depending on what sections of the city you are. But I don't know, looking at Eastern Jackson County in particular or Blue Springs, I don't know if there's that many healthier options.
Yeah.
And when they can bring in those sources, I mean, all it's going to do is drive foot count for that area and all the retailers that are surrounding.
Yeah, just yet another example of a national firm making a big bet into Kansas City surrounding areas and in retail. One thing that stands out to me to this picture, guys, is look how much parking that you have to have for retail. I mean, 280,000 square feet on 36 acres. And that's why we are not seeing new retail development, because where are you going to find 36 acres to go build 280,000 square feet in a great location? It just doesn't exist unless it's a new suburban expansion with residential being built around it. So again, just kind of highlights the fact that we saw low vacancy rates, rents going up on the retail side. So if you're interested in retail here in Kansas City, definitely reach out to our
and
team.
I think depending on the jurisdiction, I mean, typically you're going to be around 7 to about 9 parking spaces per 1,000 square feet.
Wow.
So looking at that, I mean, we can do some quick math, but 280,000 square feet. 80,000 square feet. I mean, that's a lot of I'm not doing the math off the top of my head, but
so it'd be 280 times 7, right? I mean, because it'd be 280 times 7. So you've got close to 2,000 parking spots there. Yeah. Pretty incredible there. Sorry, guys. You know, Nathan didn't have his chat GPT up, so he couldn't ask him how to do some math there. He does know how to do math, though, I promise.
I was supposed to take the zeros off to make it 1,000 to account for that. Yeah.
Oh, that's some good stuff. Anyways, I digress. All right. So retail's evolving, you know, significant shifts, Nathan, that you've talked about towards experiential spaces, mixed use developments. We just highlighted one. The industrial sector has been driven by the e-commerce boom with increased demand for last mile distribution centers. What are some of the key highlights just in general from Kansas City's booming industrial market?
Yeah, I mean, like you said, I mean, I've been seeing an increase in third-party logistics companies that are coming here primarily because of location in the region. Another thing would be when it comes to certain facilities that's catered around food manufacturing. I've been seeing trends in just going to different industrial events. I mean, that's something that like is a trend that's probably anticipated to continue for the next coming years, is manufacturing with the food industry. But with that, it comes a lot of different nuances with how that industry gets built up in manufacturing compared to looking at standard flex space. Flex space is fairly easy to accommodate when bringing in tenants, but this can be a great thing when it comes to contractors and bringing up in all these different subs that specialize in these different types of industrial, specifically with manufacturing.
One of the big trends that I'm noticing is these new buildings being either LEED certified or have some sort of green component to them, right? The ceiling heights continue to get higher and higher so people can stack boxes, they can stack inventory higher, and they want to try to bring down those operating expenses. So anything that developers can do in regards to bringing those OpEx expenses down and or making it more efficient for the tenant, I think we're going to continue to see that trend as well.
Yeah. And that is a great point. I think prior to the 2000s, I think the average ceiling heights were around 22 to about 26 feet. Now, I mean, you're looking at huge logistics hubs. You're looking at 30 feet plus. Yeah. And now in some instances, you're going to be around 36 feet, which is pretty crazy.
Yeah,
I mean, they're looking at their vertical real estate compared to just growing on the acreage. So, I mean, even though they have large distribution centers, I mean, if you can stack more up, I mean, you're able to have more product on site.
Yeah, in this picture alone, we have 3 different ceiling heights, right? You've got the office space in the front. You got sort of a smaller space right behind that. And then you got the large space that's probably that 35 feet that you're talking about right here. I mean, this is the look and the feel of these new buildings. So really interesting to continue to watch that trend. Here's one, Micah, that I think is really awesome. And I've been following this project for quite some time. This is the former AT&T offices right downtown in the East Village.
Yeah.
And the Bernstein Companies is transforming this former AT&T building, so it was an office building, into a 263 unit apartment community. So this does a couple things, right? This is an office to multifamily conversion, which I think a lot of people have been talking about. Can we figure this out? How do we do this? Well, this is how you do it here. Right here is with public financing. So this $82 million project secured $16.6 million in state and $13.2 million in federal historic tax credits which was essential to this project to offset the cost of the asbestos remediation and the property upgrades, man. But everybody's been watching this project for the last 4 or 5 years. Is this a trend that you think we're going to continue to see in Kansas City?
Yeah, I mean, over the years, we've seen multiple building conversions over to multifamily throughout downtown Kansas City. And so, but the thing that we're running into is that we're running out of buildings to convert. And so, but I think it's great that we've been able to really utilize some of these buildings instead of having to, tear them down or having them just sit mostly vacant or completely vacant, and finding a valuable use for them. And so, and you're right. I mean, I think these incentives that developers are able to take advantage of at the state and federal level are huge, because these projects just would not make sense otherwise. So I think that's a really big deal. And but I think it's great because it continues to revitalize our downtown. And so that's a really big deal. And I don't know if that's a good segue into the interstate cap on the south side of downtown over I-670. But that project is moving forward as well. And sorry.
The park that's over like I-70, 670.
Yeah, they're capping the interstate, and it's going to act as a connection point between downtown and the crossroads. And so I think it's going to blend it together well. And this is also something else, because they're modeling this project off of the project that they did down in Dallas.
Yeah.
And so anyways, I think there's a lot of people that are excited about this one because it's really going to bridge that gap between the crossroads and downtown.
Absolutely.
And so there's going to be a wonderful park there. It's going to overlook. I mean, if you are a resident at one of the 3 light, 2 light, or 1 light towers, or if you're going to an event at the T-Mobile Center, I mean, you're going to be walking through this new park that we're going to have.
Absolutely, guys. Very, very cool. And, a lot of questions that we get around is why are people building all of these multifamily properties? Why are we converting offices? Who's living there? Well, we just said that 20 to 25,000 people are moving to Kansas City every single year. And not every single one of them is going to buy a house, can buy a house, because we know what the prices of single family homes have done. And so projects like this, new developments on the multifamily side, are in need, and they are being filled up. I think our average occupancy rate is around 92 or 93% here in Kansas City. So they're coming, people are coming, and people are living in them. So very excited about this project and the project, Micah, that you just mentioned. This is a fun one, guys. This is so cool. Buc-ee's,
yes.
I know you're excited about this, Micah.
Yes.
Living in Texas, but Buc-ee's is bringing big Texas flavor to Kansas City. This is a mega travel center in the heart of KCK, and it gets the green light. So they're constructing a 74,000 square foot travel center over in KCK, and it's complete with 120 fuel pumps, 12 EV chargers, and 25 acres of space between the Kansas Speedway, and I-70, aiming to draw 4,000 annual visitors just to come to Buc-ee's, not because they're going to the Speedway or going to Nebraska Furniture Mart, just to come.
Logan, I got to chime in on this one, man. I mean, as a former Texan, I mean, this is near and dear to my heart. Because for those that don't know, I lived down in the Dallas-Fort Worth market for over a decade. And so everybody in Texas, I mean, that was one of the big things. I mean, there's always a list of great things in Texas that everybody loves to talk about. Buc-ee's is one of those, just like Bluebell ice cream is one of those, another one. But everybody always talked about Buc-ee's, and being a fairly new resident of Texas, you know, I was there for a few years before I'm like, Buc-ee's, like, what's the big deal, guys? It's a gas station. Who in the world cares about a gas station? And then they opened a new Buc-ee's right down the road from where I lived, because I lived just a little ways away, a couple exits away to the Texas Motor Speedway. And they built the Buc-ee's down there right across the street from it. And when I went into that Buc-ee's and experienced it for the very first time, I looked around and I said, okay, I get it.
Yeah.
I get it. And I think it's one of those things, you have to actually go and make the visit, and you will get it. You will understand why people go nuts over Buc-ee's. Yeah. It's incredible.
Look, I mean, over 4,000 people are planning to do that on an annual basis. And I will be one of them, taking my whole family up there, getting my car washed, hanging out at Buc-ee's and fueling up. So we're excited to welcome the big Texas flavor to Kansas City. Very cool. All right, guys, we had the latest Federal Reserve meeting last week, November 6th and 7th. And, you know, obviously they decided to cut the rate another quarter point, right? And everybody's been looking at and watching what the Fed is going to do. Everybody's been prognosticating about it right now, and the potential impact of a new administration coming in and all this. Some of the key insights, though, I mean, we are now in a rate cutting cycle. Okay. That's what the Fed has said they are going to continue to do and what their plan is. And they have backed that up. So that is substantial in and of itself, because no longer are we raising rates or holding rates steady. We are cutting rates back down to 4.5 to 4.75%. Now, everybody's been talking about the 10-year Treasury and how it's actually gone up. Why? Well, because there's a lot of concern around inflation coming back, especially with potential tariffs coming and things like that, with immigration and all the new administration's thought processes. So, but what we're tracking here, at least from a commercial real estate standpoint, is what the Fed has said they are going to do, what they are doing, and they are continuing to cut. And so we're tracking this on a regular basis here. And I think that, you know, frankly, a lot of people are watching this. But just remember, we had Robert Meehan on, capital markets expert, one of the most highly watched episodes here on the Market Pulse. It's been watched over 15, 16 hours now, talking about the impacts of the 10-year Treasury and how to think about where interest rates may be headed and where they are going. So please do go back and watch that. Just know that we are going to always be presenting and bringing the most up-to-date information in regards to what the Federal Reserve is talking about and what they are doing, because that does create a lot of sentiment for our investors and for our property owners that we're working with.
I think a lot of people, there's this misconception that people talk about is when the basis point, the Fed rate comes down, they anticipate the interest rates coming down. But what people don't anticipate is that if the interest rates are being based on the 10-year Treasury, for example, that 25 basis point decrease has already been accounted for a few weeks ahead of time.
Exactly.
And that's just one thing that people fail to realize. You see a lot of people on social media saying, "Oh, the mortgage rates just came down." I'm like, they didn't come down relative to that announcement. They've already been coming down the previous few weeks.
It's very confusing for a lot of people, and we spent over an hour with a capital markets expert diving into that 2 weeks ago. So please, or 3 weeks ago. So please do go watch that episode. It was highly valuable, and somebody who's been in that space for 25 years plus, working and understanding interest rates. So great point, Nathan. I think that one thing to note is, the federal rate does have an impact on shorter duration loans, such as credit cards, auto loans, and things like that. But we don't sell any of that here. We're not helping anybody with that. And I don't want to get on a rant about credit cards and vehicles here. So we're not going to do that because we'll be here all day long. But let's talk about, guys, because we're coming up on time. It's been an awesome episode, but looking forward, right? Opportunity ahead. Looking forward, Kansas City's commercial real estate market is expected to experience continued growth across multifamily, retail, and industrial sectors. We've got economic conditions that we're tracking. We're looking at the interest rates, understanding the supply chain stability, and that's all going to shape 2025 with anticipated growth. And I've been hearing it called the Trump bump. There's always a name for this stuff, but there's something to be said about our last guest. If you go back and listen to and watch our episode with Robert Meehan talking about interest rates, then Akhil Patel talking about the 18-year economic cycle, we do not foresee next year or maybe even the year after really being a slow year for commercial real estate. Okay. We see this being a good time to be thinking about investing in property. And if you're an owner of property, positioning yourself to be able to sell at the height of the peak and being able to find yourself a safe replacement property. So, but I want to ask you guys both closing thoughts in regards to what is your prognostication and what is your forecast ahead for 2025. Micah, let's start with you.
Yeah, I think there's a lot of positive things that are ahead, and I think we're going to see a fantastic market, a very busy market over the next couple of years. And so the other thing too is if you're thinking about, well, I want to time the market and I want to get these rock bottom deals and all of that, I would speak to that and just say, if you're on the sideline and you're thinking about whether you should pull the trigger on a deal and whatnot, I would say right now is probably a really good time to engage in the market and buy, because I mean, everybody's been talking about how the market is going back up. People are really engaging. You've got Blackstone dumping billions of dollars into the market and with this acquisition. And so activity is going up. And what does that translate to? It translates to pricing going up. And so if you're on the sideline trying to determine whether you should acquire something, now's the time to jump in and do that. And so if you're looking for a good deal, whatever that is, I would say right now is a better time. And just to put it in perspective, I mean, do you think right now would be a better time compared to a year from now when prices could potentially be tremendously higher? Mm-hmm. Well, I mean, the logical thought process on that is, well, right now would be an excellent time to get something under contract and transact. That just sounds like the smart move, given that I foresee that we're going to be seeing a lot more economic activity in the days ahead. So that's kind of my 2 cents on the subject.
Absolutely. Nathan, what key strategies are you suggesting for retail and industrial owners and investors that are aiming to stay competitive in 2025?
Yeah, I mean, I would say I take a somewhat contrarian viewpoint to a lot of this. I always say, I mean, it's always a good time to buy as long as the project pencils. I think when it comes to selling a property, it really comes down to the interest rates. I always say when the interest rates are super high, that's really when you need to be buying. When the interest rates are super low, that's a great time to sell because you have more competition, more buyers that are willing to purchase your property, and that just drives the price up even more. So as we see the interest rates start to come down, sellers out there, property owners, you should be selling in the next year, primarily because you're going to be able to maximize the value of your property just because you're going to create more competition for yourself.
Great insights. Nathan. Great insights, Micah. Very much appreciate you guys coming on, sharing your expertise. If you heard something that you want to talk more about, feel free to find Nathan, find Micah, myself. We're easy to get a hold of, and we'll talk to you guys soon on that front. If you want to come meet us, we're going to be at the CCC event on Thursday, December 5th, 2024. It's the holiday blowout project. And
Golly, is December that close? My goodness.
in a few weeks. It is in a few weeks. So, I'll share something personal here because people keep telling me I need to do more personal stuff. But, I'm pretty private in regards to that. But whatever. My daughter turned 1. My youngest daughter turned 1 yesterday. So, and just thinking about the 12 months that she's been with us and what life was before and what it is now and how we can't even think about how it'd be there and how fast it all went by. Yes, it just happens very quickly. But I'll tell you guys, I have developed relationships. I have built pipeline and made incredible connections at this event. They're highly, anticipated. There's a lot of people, probably 300, 400 people that'll show up to this event. And they have great food, great drink, and it costs money to be there. And so you're going to get a pretty high level of person there that's willing to come and talk and try to get some things done. So please do come see us there. Our multifamily meetup group is done for the year. Holidays coming up. It's hard to get dates scheduled. So we'll pick that back up in January, but please do come see us here December 5th. Thursday night, 5 to 9 p.m. out in Shawnee, Kansas. There it is again, guys. Shawnee. I tell you what, everybody is. We've got more and more stuff going on in Shawnee, Kansas. But we don't have any time for any questions today. So if you have questions, please feel free to reach out to us. Comment. We'll make sure to get you guys what you need. And if you're ready to get started and you're ready to talk more about how we can help you either find an investment property, sell your property, do a performance audit on your property, please do reach out to us. Just head over to our website, exchangecre.com. Find us on LinkedIn. Our numbers are everywhere. And we look forward to having a conversation with you and helping you with your commercial real estate goals. Nathan, Micah, everyone who is tuning in, we very much appreciate your time and thank you for coming on. Until next time, we'll see you guys later.
Thanks, Logan. Appreciate it.
Thanks, Logan. See you, Micah.
See ya.